Alexander, it's great to have you here this morning. You just heard Dan Murphy's report on the ongoing tensions in Syria and Turkey. We've heard about the election debates last night. From a trading perspective, what is the thing that those investors and traders need to watch the most as these markets hover near record highs?
So I think the S&P isn't really telling us an awful lot. It's hovering near record highs, as you say. It's really about what's going on below the surface. And I think below the surface, there's a lot of interesting dynamics with regard to the story this year has really been a flight to safety all of the year. We had a small unwind of that in September, but in reality, it's been a case of I want to be invested in things like utilities. I want to be invested in things like anything that's going to be yield sensitive that effectively acts as a proxy of the 10-year. And so despite markets actually at these levels, the nature and investor sentiment below the surface is actually pretty, it's not particularly
So that's interesting. So how exactly then do you craft a trading strategy around that if things are somewhat maybe synthetically moved towards just one particular trade in safety versus risk of risk aversion versus taking on risk, or is it certain sectors in particular that might be the ones that you want to focus on going ahead?
So the risk right now is crowded. And I think that's the biggest thing that investors need to think about when crafting an investment strategy, is that clearly this defensive trade has worked for a substantial period of time. You could argue it's actually worked. Owning growth versus, say, value stocks, for example, has been a trade that's been working arguably since 2010. And it's now become incredibly crowded, and it's become synonymous with record levels of low yields. And so the risk that we have right now, and what we think about as a team a lot, is how do we position potentially for an unwind of that, even if it's short and sharp. That's something that we need to be mindful of.
So last year, we noticed that healthcare was the best performing sector. This year, it's one of the laggards in the overall market here in the U.S. Some would argue that a lot of that has to do with what's happening politically. There's a lot more rancor coming out from the Democratic side of things about how to tackle healthcare, that sort of thing. Managed care companies are taking a hit. So how exactly does the election play out in terms of how traders should be strategizing what they should be doing going forward?
I mean, again, to highlight the point, it's not just what's happening in S&P. So you highlight healthcare, but actually, when we think about the risks from any kind of political narrative, there's also risks around tech. There's risks, clear risks around financials. There's clear risk around energy as well. And what's interesting is that healthcare's had almost a myopic focus on it to the detriment of that sector, and yet actually looks at very interesting levels where it's largely discounting, or at least partially discounting, a potential adverse outcome in 2020. And yet actually it's the other sectors which I think are probably more interesting in terms of putting the spotlight on them on the potential risks.
Is it all just noise? Should investors really be paying attention to what the election outcome is for their longer term plans on how to be kind of deployed in the market?
So I think the issue with markets right now is that you can have 12, 18, 24-month views, but unfortunately we've all become quite short-termist in terms of our ability to trade it and withstand sort of mark-to-market shocks. And so, yes, we can have a view on what the 2020 election outcome should be, but actually right now what investors are trading is who's going to be the Democratic nomination.
Is the Fed still the foremost part of the investment thesis right now?
I think we should always consider the Fed to be at the front and center of our investment process. The old adage goes, don't fight the Fed. But in reality, there obviously are other factors at play. I think the biggest issue with the Fed right now is, do they still have the potency with regard to either conventional or unconventional easing measures?
Quickly, do they?
I think that as the old saying goes, it's very hard to fight the Fed. And if the Fed do have a problem in terms of their perception amongst the marketplace, they're not alone. I think it's a broader central bank issue.
All right. Alexander Altmann, thank you very much.